So we discussed about three types of losses, which is expected, unexpected, and exceptional. Exceptional means we can't, we really don't know. It is uncertainty. So we don't bother about it. If it happens, we will take care of it. Otherwise, we'll forget about it. Then we spoke about expected loss, which is the probable loss, which we counter. Like every year, we plan for portfolio growth. Similarly, we plan for the losses, which are NPLs. Right? So this part of loss is tackled through provisioning. Right? Then the unexpected loss, which is beyond the expected loss, where we can't do anything because we have not planned, and we can't go back to our liability holders and say that we have an issue. So we need our own money, the owner's funds, where we can go back to the owners and say, we made a mistake, this is the loss, sorry, we can't pay you back, right? That is the owner's funds. So that owner's fund, which is known as capital. So unexpected loss is covered through capital. So expected loss through provisioning, unexpected loss from capital, and exceptional loss we don't look at. Why we need capital is to absorb this kind of losses, protect depositors. That means we absorb the loss so we can protect the depositors, then give confidence to the investors and rating agencies. Why? When we talk about a project, we talk about capital, that is sponsors' contribution. So in a bank also, we need our own money. Right? Capital adequacy, same thing, provide buffer against the bank losses, protect creditors in the event of bank fall. And this is the key point, third point, disincentive for the excessive risk taking. So now we are shifting to Basel. At that point, I will tell you what this means. These are the three types of capitals we have, right? Economic capital, estimated level of capital we need, and regulatory capital, which the regulator wants us to have. And the bank capital, which is almost equal to economic capital, the actual capital held. Right? So we discussed all these things we discussed. So I'm just brushing you through. Capital, we have three types of capital: tier 1 capital, tier 2 capital, and tier 3 capital. Tier 1 is the share capital, then P&L reserves, those kind of things. Supplementary capital is debentures, provisioning, then subordinated long-term loans. Like that, we can have several things. Then tier 3 capital is subordinated 2-year maturity loans, right? That is only 25% of core capital or tier 1 capital. Then when we talk about capital, capital equals tier 1 plus tier 2 plus tier 3 minus deduction. That is goodwill and investment in unconsolidated banking and finance subsidiary companies, and investment in the capital of other banks and financial instruments. So when we talk about capital, this is the formula: tier 1 plus tier 2 plus tier 3 minus these two items. Right? Why this Basel came? I told you 1974, there was a bank collapse in Germany, which is called Hazard Bank. They were doing a transaction across ocean. They had opened a bigger LC to US, but they have not paid it, right? Because since it is huge, German government has closed down this bank. So because of that, we had an issue. right? In order to avoid that kind of a situation, Basel Committee on Banking, BCBS, was started, right? G10 countries, all uh, governors, central bank governors came in to decide what to do. In that scenario, they developed this Basel Capital Adequacy Guidelines, right? Why? It is to have a level playing field on all internationally active banks. That means if you are playing internationally or if you are doing business, you need to have your own capital. If you are small, do small business. If you are big, you do bigger businesses. If you want to do big business, you have to gradually graduate to bigger size. That means you need to build your own money in order to do big business. That is the essence behind this. Banks from different countries competing for the same loans would have to set aside roughly the same amount of capital on the loan. That means for any loan, we need to set aside our own capital, our own money, right? Not everything can be borrowed and relent. How do the banks are financed? We have fixed deposits, we have CASA, we have term loans, our own borrowings, we have short-term money market, and then we have our capital, right? So you need to allocate part of the loan from your own money. Other parts you can fund from other liabilities, right? So 1988, first Basel I came, then there were few changes to by 1992, Basel I was fully effective. Then we had two changes, 93 and 96. Then Basel II came in 2004. Like when we talk about Basel I, why the snapshot, if I give you a snapshot, the purpose was to prevent international banks from building business volume without adequate capital backing. That's what I was talking. If you are playing in a field, you need to have your own money to back you. In case of unexpected loss, you should be able to bear that loss. That is the meaning, right? Then under Basel I, what they said, capital risk is the main risk associated with a bank. Therefore, we look after capital risk. Focus on credit risk, right? Not capital risk, credit risk. Then they introduced this minimum capital adequacy, capital standards for bank, effective 1990. So under Basel I, we talked about only about credit risk. Then under Basel I only, capital adequacy guidelines, ratios came into effect. So Basel I is held to incorporate risk into calculation of capital. This is how we do the capital calculation, right? Basically, minimum capital adequacy or capital ratio we call as Cook ratio. That is because of Mr. Peter Cook, Governor of Bank of England. That is the Central Bank of England, right? Cook ratio equals capital divided by risk-weighted asset. This part, right? Capital divided by risk-weighted assets. It started with should be more than 8%. Capital divided by risk-weighted assets is the minimum capital adequacy. The ratio started with 8%. This is the ratio Basel gave, right? Based on the different countries, like Sri Lanka can decide, okay, Basel said 8, but we start with 10. Like that, different countries were allowed to decide their own minimum capital adequacy, but Basel said you need minimum of 8%. That means, very layman terms, if you are lending 100 rupees, you need to have 8 rupees from your own funds, and balance 92 rupees can be borrowed through the other means, that is fixed deposits, CASA, term loan, short-term loans, anyway, and relay. But you need to have your own funds minimum of 8 rupees out of 100 rupees. Right? That is the capital adequacy meaning. The other part is co-capital plus supplementary capital minus deduction. Then we have a word risk-weighted asset. Right? We have what do you like? If you take just asset, we know that it is the loans. But when it is risk-weighted, what does that mean? Again, before going there, we have another thing. We have on-balance sheet assets and off-balance sheet, direct assets and indirect assets. If you can remember, first or second and third lecture, we discussed these things, right? On-balance sheet assets means term loan. Any facility where funds flows out of the bank is an on-balance sheet asset. Term loans, credit cards, housing loans, PODs, all those things. Off-balance sheet or contingent or indirect assets are where bank take only a responsibility. There is no cash flow effect on those kind of things. LCs, bank guarantees, performance guarantees, all those things. So when you are talking about asset here, this one asset, it includes direct assets as well as indirect assets. So whenever you want to calculate this asset book for capital calculation, you take the balance sheet assets plus you have to convert all the you have to convert all the indirect assets into direct. How do we do that? We multiply the indirect assets like LC values, bank guarantee values, performance bond values with a factor called credit conversion factor, CCF. The factor is called credit conversion factor. The factor which is used to convert off-balance sheet items to on-balance sheet items. Right? Examples. Standby letter of credit to do purchases. Then CCF for that kind of asset is 100%. Performance guarantee, it is a 50%. Sorry, it is a 20%. If we go to our other handout, you have this handout as well. Slide number 12. Look at this. Standby letter of credit, it is 100%. Performance bond, it is 50%. Right? Short-term trade, like you want to open a LC to buy sugar. Then it is only one of LC and there is an underlying transaction, specific transaction. That kind of LCs you multiply by 20%, 100%, 50%. These are the three factors to be CCF, three items. Right? In your one of the other handouts, I have given a detailed list on the items as well. That is handout 9, if I can remember correct. Handout 9 onward, additional information. Right? So this is CCF, the factor which is used to convert off balance sheet items to on balance sheet items. So just remember standby example, standby letter of credit, performance bond, and self-liquidating trade DLCs, which are 20%. Right? So that is the asset. Asset consists of on balance sheet and off balance sheet. Off balance sheet you convert using a credit conversion factor. Right. Then we go to risk weights. Basel 1 gave us 4 risk weights. Like they said, okay, if you are lending to US government, treasury, or OECD, Organization for Economic Cooperation and Development. There are 34 countries in that, all the G10 countries and some other countries like India, Brazil, like that. We have 34 countries under this OECD, right? So if you are lending to any one of those countries, your risk weight is 0. Then if you are lending against OECD banks, municipality council, US government agencies, claims on municipalities, then it is 20%. If you are lending against residential mortgages, it is 50%. Any other thing, it is 100%. Right? So these are the only 4 items they gave. I have given you a handout, Word document today. This is the Sri Lankan, like this is the details. You can use this based on the country situation. Right? Private sector. This is our requirement. Right? This is the detailed one. Earlier what I said is the summarized version. Right? 0, 20, 50 and 100. Right? So these are the 4 risk weights they have given. If you are lending against OECD government or US Treasury, it is 0 risk, so you don't need capital. Why? The risk weight, this part will become 0. Right? No need for capital there. Right? So capital equals 8% into risk weighted asset. When it is becomes 0, capital will be 0. Second one, if it is 100 rupees, it go next slide. I have an example. This is the example. Right? You want to lend $100 or 100 rupees to a company where risk weight is 100% and the capital adequacy 8%. Capital adequacy ratio, capital divided by risk weighted asset. Ratio is 8 here, capital 100, then risk weight is 100%. So when you multiply all those things, capital is $8. That means when you want to lend $100, you need to have your own funds of $8. $92 you can borrow and lend. So if you are lending to mortgage facility, then this will become 50%. Right? So it will become $4. If you are lending for US municipality councils, this is 20%. So it will become $4. Like that, based on the risk weight, your capital requirement changes. But Unfortunately, all the corporates were put on 100% bracket. So there was no difference between a very good corporate and a normal micro facility. Everything treated the same way. So to calculate required capital, bank would multiply the assets in each risk category by category's risk weight and then multiply the result by 8%. This is what I did here. Right? Then I'll take only this part. Basel 1 focus only on credit risk, single risk measure, right? Credit risk. Then second one size fits all. What does that mean? I told you Basel 1 gave 100% risk weight for all other private lending, right? So we take a local example. John Keys come to a bank to borrow, and a normal Mr. Pereira who runs a grocery comes to bank to borrow from a bank. Both credit are same equal risk weight. 100% capital for John Keys and Mr. Pereira also 100%. So there is no difference. So what the banks did, instead of going for good credit, they went to moderate credit and high risk credits. Why? Then we talked about risk return trade-off. Higher the risk, higher the return. So with the same capital, two banks operated differently. One bank who wants to have a value-driven culture went only to the big customers or low-risk customers. Their margins may be low, but their quality of portfolio would be higher. But with the same capital, some other banks, they went to high-risk categories where their profitability was higher, but their quality of portfolio, the risk of portfolio is higher, right? So we are talking about 1990s, right? So those days, disclosures was not that big. Those days, annual report is 10 pages, 20 pages. Today, hundreds of pages. So what happened? Investors, they just go by the P&L and the balance sheet. You see a high profitability, investors go and do investment. So we put investors into risk because of this capital, thinking of only one type of risk and same level of capital for all the portfolios in the overall portfolio. Right? That is called regulatory arbitrage, regulatory capital arbitrage. That means with the same capital, two banks can act completely different ways. Right? With the same capital, one bank can have a very good portfolio, another bank can have a high risk portfolio, same capital. Then Basel 1 started talking only about credit risk, whereas subsequently they took the market risk as well, 1996 amendment, but they never spoke about operation risk. We consider Basel 1 as single risk indicator, right? So they don't bother about market and operational risk. That is Basel 1. But Basel 1, Basel introduced the risk part to capital calculation, and minimum capital adequacy calculation was introduced by Basel. What is it? It is capital divided by risk-weighted asset. When you talk about asset, it is on balance sheet asset plus off balance sheet asset. Off balance sheet needs to be converted to on balance sheet. How do we do that? Off balance sheet multiplied by credit conversion factor, which is 100, 20, and 50. 100 is for standby letter of credit, 50 for bank guarantees, performance guarantees, bid bonds, those kind of things. Then 20% is for trading letter of credit, where there is a specific segment, specific shipment attached to a LC. Right? Those are the factors. So you multiply the off balance sheet with the credit conversion factor, then it will become on balance sheet facility. So Basel I discussed only about one risk, that is credit risk. Right? Based on that, they gave 4 different risk weights: 0, 20, 50, and 100. All the corporates, normal business corporates, or all the business people were categorized on the 4th category, which is 100% capital. Therefore, the best corporate and the micro both were treated the same. As a result, banks could operate differently with the same capital amount, which is called regulatory capital arbitrage. So they were talking only about one risk. We had leeway for regulatory capital arbitrage because of this, and we never spoke about other risks than the credit risk. Therefore, we needed another development on Basel. Right? Before going there, any questions up to now? Any unclear area, anything? Chat box is on, you can text or you can tell me. Okay, Sashi, but about other? All good? Can I go to Basel 2 then? Others are silent. Only you. Okay. Right. Then came the Basel 2. Right? Second development on Basel. Under this, more emphasis on banks' internal methodologies, supervisory review, and market discipline. Under Basel II is said to be a 3-pillar model. Just after this, I'll go to that. So they discuss different ways of risk management within the bank, allow the banks to do risk management practices. If you are good on managing your risk, we will consider you good and your capital requirement will be lower. Similarly, they wanted supervisor or regulator to look at our portfolios and discuss the capital. That is the supervisory review. Thirdly, it is the market who will decide about the bank. So earlier, no weight given to the internal risk management procedures. No weight given for reviews, supervisory reviews. Nothing to do with the market. It is only 4 types of risk categories. Right? Then flexible menu of approaches. There are several ways we could calculate our capital requirement based on the management level of risk, right? Then thirdly, they introduce a mechanism to calculate market risk, operational risk. Market risk started in 1996. Is an amendment to Basel I, but normally we consider Basel I considered only credit risk. Basel II considered credit, market, and operation, all three risks. So as I told you, it is a three-pillar model. Firstly, minimum capital requirement, supervisory review process, and market discipline. This is how we calculated the minimum capital adequacy under Basel II. Earlier it was only this one. Subsequently this one came in, but with Basel II only this is included. Capital divided by credit risk, market risk, and operational risk. Right? Pillar 1 will decide on all these three risks. We have to calculate capital based on these three risks. They gave us different ways of calculating risk, capital requirement under these three risk categories. Then pillar 2, supervisory review of institutions' capital adequacy and internal assessment process. So they gave another mechanism. You decide on your portfolios because there are other risks which are not covered under pillar 1, like legal risk, reputational risk, settlement risk. All those things you have not calculated. So you decide the capital requirement for that, and supervisor need to recalculate or authenticate the capital adequacy. That is the supervisory review. Thirdly, they said you need to disclose everything, right? You have to be very transparent. Then the market will decide whether you are good, whether you have been transparent, your operations are good, and they will decide whether to invest in your bank or to invest in another bank. So indirectly, market will control you. If you don't disclose, if your portfolios are bad, market will decide, no, I'm not going to invest in your bank, I'm going to bank B. Instead of bank A, bank B. That's how market will regulate. That's how our annual report started becoming bulkier and bulkier every day. Right? Now we discuss about risk management processes, we discuss about environment, we discuss about CSR, we discuss about remuneration to the board, remuneration to the top management, we discuss portfolio quality things, we discuss everything on the annual report. Why? The investors will go through this and decide whether to invest in bank A or bank B. If the investors decide otherwise, bank A will not get money. Therefore, they have to be very careful and very disciplined. Right? So, pillar 3 is market disciplining. Pillar 1 is capital adequacy calculation based on credit risk, market risk, and operational risk. Pillar 2 is the supervisor review process. Under that, all other risk has to be taken into account and capital adequacy has to be calculated for that. This is what I showed you earlier. Pillar 1, capital divided by credit risk, market risk, and operation risk. Each of these risks, there are 3 methods of calculating capital. If the bank's owner, same thing. Okay, under credit risk, these are the 3 methods of calculating capital, right? Standard method, internal rating based method, basic method, and internal rating method, advanced. IRB, internal rating base. IRB means internal rating based method, right? IRB basic, open foundation. IRB advanced, oh no, it is advanced. There are 3. If we go to, we take it from this slide. This one I have given you. Percent. 10 countries. This all I spoke to you about. On balance sheet and off balance sheet. All these things I spoke to you about. Right. This is the standard approach. Then second one is foundation IRB approach. Then advanced IRB approach. This is the credit risk, right? Then market, you have like I'm going to discuss in detail from this, but you just need to know the names, not the processes, because it does not cover under your syllabus. So I used to teach, but it is not covered now. So we have standard approach, internal model approach for market risk, and operation risk, basic indicator approach, alternate standard approach, and advanced measurement approach. This is this one, right? Standard approach. This one, right? Standard approach is similar to Basel 1. What happened on the Basel 1? They gave 4 credit rating, risk ratings: 0, 20, 50, and 100. Similarly, under standard approach, what they said, you can get an external rating for your customers. Based on the external rating, they gave different risk weights. If a customer is AAA to AA minus, your risk weight is 20. Under Basel 1, whether you are a AAA customer or unrated customer or default customer, risk weight was 100. Right? Now what they did? You get an external rating. Based on the external rating, they gave different risk weights. So you can use for AAA to AA minus 20%. A plus to A minus 50%. Like that, they gave different weights. So your capital requirement came down. So earlier everyone was treated the same, but here, based on the external rating, they gave risk weights. So your capital requirement came down. Here, unrated customers are given 100%, whereas below B, that is default rate, it is 150%. of the exposure. Right? Why unrated 100%? Unrated does not mean they are risky. There can be very good customers unrated. There can be risky customers. So they gave 100%. But B minus means we know that this customer is into what? Speculative rating. So you have to be very careful. It is 150%. It is the same for our country now. We have slipped to triple C. Right? So our risk weights are high now. Therefore, our borrowing rates will be higher. Then we'll take the one IRB basic. The formula used for this is expected return EL equals PD probability of default into LGD loss given default into exposure at default. I will explain each term separately. So under IRB method, both IRB basic and IRB advanced, both the method used is expected loss equals PD probability of default into LGD loss given default into exposure at default. Right? This is the formula we use. What's PD? PD is probability of default. We take this. Yes.
Sir, are you showing us the slide number 63?
66.
Sir, we can see the slide number 6. Right.
Can you see this slide now?
No, sir. Still it shows the 63.
That means this one. Basel 2 consists
Yes, sir.
3 pillars.
Yeah.
How come that happened?
So, but I can see the 66 when you present it.
Is it? Just hold on.
Me too, sir.
I also can see.
So then maybe it's my problem. I will log out and log in and check it again. Thank you, sir.
Can you see it now? What is the slide you can see now?
64.
64, 65,
65,
Yeah.
66.
66.
66.
Right. Then it is your problem. Can you check your Kanita?
Okay, sir. I will check it.
Right. Okay. Right. So for both the methods, the equation we use is PD into LGD into EAD. Right. We'll take one by one. PD is probability of default. We take the probability of default from our internal risk rating. What do you mean by risk rating? It is the credit worthiness. Highest credit worthiness AAA has the lowest probability of default. What is the probability a customer will default? Right? That is probability of default. So it is linked to your risk rating. Then loss given default. That means if a facility, it is based on the facility type. Right? If a facility goes bad, what is the probability of loss? I'll take you this way. You have given a POD. TOD, temporary overdraft, right? As of your last 5-year data, if a 1 million TOD goes bad, if 1 million TOD goes bad, you recovered only 40% of that. Whenever, as of the 5-year data you have, if a facility, TOD facility goes bad, we take 1 million, you recovered only 400,000. That means your recovery rate is only 40%. Right? If TOD is 2 million, you recover only 80%. 80, not 80%, 800,000. So because based on previous data, whenever a product goes bad, this is the percentage we recover. We take a leasing facility. If a leasing facility goes bad, we recover almost 80% of it, the outstanding. Right? That means 1,800,000, 2 million, 1.6 million we recover. That is called recovery rate. Loss given rate is 1 minus recovery rate. 1 minus recovery rate is the loss given rate. That means if 1 million goes bad, what is the percentage we will lose? So initial example, TODs, we recover 40%. So loss given rate is 60%. Leasing, loss given rate is 20% because our recovery rate is 80%. Then exposure at default. That what is the overall exposure if a customer goes bad? Long-term loans, you can take only the outstanding balance. But where short-term, you have to take the exposures sometimes. Like if we have issued bank guarantees, that is the exposure we have to take. Right? You have issued checks, then we have to take that part. So it is the overall exposure bank will have. There is no claim, but you have issued a LC, you have issued bank guarantee. There are no claims yet. Customer goes bad. So you have to take into consideration those unclaimed exposures as well. So what is the overall exposure we have to a customer? That is exposure at default, at the time of default. Long term, easily we can take outstanding. Short term, you can't. You have to consider overall exposure there. Unclaimed exposures as well. Right. So it is the EL, expected loss, equal PD into LGD into EAD. Right? Under basic criteria, basic IRB basic or foundation, banks are allowed to take their own values for PD. Banks are allowed to take their own values for PD. But LGD and EAD, they have to take the supervisor's approval, central bank's approval. When it comes to advanced model, what happens? Central bank will evaluate our risk processes. And based on that, they will approve the model. Then we don't need to go every month to central bank for approval. We can take our own calculation into account. That is the advanced model. First model, standard method. There, if a customer is risk rated through an external party, external rating agency, they were given risk weights. Based on that, you can calculate the risk weight. Right? It is almost similar to Basel 1. Then, if your risk methodologies are better, you can go for IRB methods. Expected loss equal PD into LGD into EAD. Basic model, you can take your own values for PD. LGD and EAD, you need to take the supervisor's approval. Advanced method, you can take all your calculation. You don't need to get the supervisor's approval. Right? Then operation risk, they have given 3 methods. Basic indicate approach, the standardized approach, we call BIA, TSA, then AMA, advanced measurement approach. These are the 3 approaches they have given for operational risk measurement. Right? You have details are there, you can just go through it, but at least you should know operational risk, capital adequacy. You have these 3 approaches: basic indicate approach, the standardized approach, and advanced measurement approach, or commonly known as AMA. Right? Then when it goes to market risk, again they have given 3 approaches: historical simulation approach, the parametric or analytical approach, and the Monte Carlo simulation approach. So market risk, they call VAR approach. V capital A simple, R capital VAR approach for market risk. And these are the 3 methods allowed to calculate your capital adequacy for market risk. Right? Historical simulation approach, parametric or analytical approach, or Monte Carlo simulation approach. You have to start with first approach. When your risk methodologies improves, you can get the approval from central bank to go into advanced methods. Right? When you are going into advanced method, your capital adequacy requirement comes down. That means if your risk management processes are good, the capital allocation should be lower. You can maintain your own proper risk management. That is the thinking behind it. Initially, Basel 1, they had only one risk rating, risk category, credit risk, and there were only 4 types of risk weights. Therefore, Basel 2 came in. Basel 2, it is a 3-pillar model. First pillar, we looked after credit risk, capital, market risk, and operation risk. Based on your risk management, each risk can be calculated using several methods. They gave several menus of approaches. Based on the risk management practices you continue, you can go from one method to other. When you are improving your risk management, the capital requirement also can be lower because Basel is confident about your risk management. So you have to be thorough with credit, capital calculation for credit risk, but for market risk and operation risk, at least you should know the methods. Name the methods. You need to have an idea about this, right? That is pillar 1. Then we go to pillar 2, supervisor review process, right? We have a process called why this pillar 2 came in? Because there are only few items were covered under pillar 1. That is credit risk, market risk, and operation risk. But there are other risks associated with the banking operation. Like this. Right? Liquidity risk. Right? That is, what do you mean by liquidity risk? If a customer is not paying on time, it is a liquidity risk. If we can't get our long-term liabilities settled, then it is liquidity risk. Settlement risk. Contracts are not settled properly. Reputation, related to reputation, legal and compliance, economic and regulatory, strategic risk. Like that, we have several risks, right? So you need to allocate your capital to cover these risks as well. You know, as a banker, you know your portfolio and your operation. So based on that, you need to allocate for these uncovered risk under pillar 1. That is the pillar 2 thinking. Right? Banks are advised to develop internal capital adequacy assessment process. We generally and popularly known as ICAP, right? And set targets for capital to commensurate with the bank's risk profile. So in order to cover all the previous risks which I mentioned, internal capital adequacy assessment process. Then what happened? Banks develop this process and we calculate our own capital requirement over and above pillar 1's capital requirement, that is capital, credit, market, and operation. We have to allocate capital for the risk arising from other activities and risks of the bank. That is internal capital adequacy assessment process. Then what happened? Supervisor will review that. Supervisory authority is responsible for evaluating how well banks are assessing their capital adequacy. So we have to get the approval from the supervisor, that is the central bank, bank supervision, central bank, to allocate this capital. We can't just say this is our capital requirement. You need to get the approval from the supervisor. Supervisor need to review the processes and approve this. That's why this pillar 2 is called supervisory review process. We do our calculation, but supervisor need to approve, review our processes, our allocations, everything supervisor need to review. That is pillar 2. Then I discuss about pillar 3. Pillar 3 is market mechanism. You need to disclose everything. You need to be transparent. You need to be good. Then only investors will decide whether to invest on your business or go for something else. Someone else, not something else, someone else. Based on that thinking, you will be regulated. Your capital will be regulated because your investors are moving out, your shareholders are moving out, so you don't have capital. Whenever they are coming in, you will have capital. Without capital, you can't lend as well. Right? There is a minimum capital adequacy ratio. So Basel II, this is a pictorial way to show 3-pillar model: minimum capital, supervisory review, and market discipline. Minimum capital is risk-weighted asset, definition of core capital and supplementary capital. Then risk-weighted assets, we have three types: risk, credit, operational, and market risk. So like that, you can show it. Then Basel II, the other problem here is, because it is almost the system-driven thing, and very larger banks will operate differently than smaller banks. Why? The capital expenditure, knowledge, experience, everything differ. Therefore, there will be a there will be a different level of capital allocation between large and the small. Even with the same credit quality, smaller banks will allocate higher, large banks will allocate lower. Why? They will have different good practices, whereas we are yet to develop those practices. When we talk about larger, it can be international or local larger banks. Right? In long term, because of this capital change, because it is linked to your risk management practices, so there will be a competition. This is yet to be known. And then earlier what happened? Straight away supervisor said this is what you need. But now what supervisor has to do is supervisor has to check whether banks are doing their calculation correctly, from ordering to checking the integrity. So that is a vast different jump from the supervisory role. That is the Basel II, right? Then now we have Basel III, which is the addition to Basel II. Right? Put this handout. Basel III. Under Basel III, they were talking about mainly quality of the bank capital. Right? They were talking about the share capital. They wanted to increase the share capital as much as possible than just working on total capital. If I go back a little bit. What is this like? Slide number 28 of this additional handout. Right? Tier 1 capital should, like when it is 8%, should be 4% of RWA, risk-weighted asset. Then within Tier 1, we have something called Core Tier 1. Core Tier 1 is share capital. Right? Tier 1, when it is total capital adequacy is 8%, 4% should be Tier 1. Then out of the 4%, 2% has to be Core Tier 1. Core Tier 1 is the share capital. Then we talk about Tier 3, which is subordinated debt with a maturity of 2 years. Then Tier 3 should be limited to 25% of Tier 1, right? And it is only to cover the market risk as well. Tier 3 is only to cover market risk, and it should not be more than 25% of Tier 1, right? Then we talk about Basel III. It is talking purely on the quality of banking capital. Again, it is the share capital. So on top of the previous methods, they introduce main differences. They introduce two ratios: capital conservation buffer and counter-cyclical buffer. Right? That is, we need to, on top of the capital calculation, you need to have this allocation as well to capital. Capital conservation, it is 0.625 to 2.5% of RWA, risk-weighted asset. Right? Every time you need to allocate that capital, but you can't use it for your lending. If you use it for your lending, in the worst case scenario, you can't meet your capital adequacy, so then you can show that part. Then in that kind of a scenario, you can't pay dividends to your shareholders. Right? You have a capital issue. In that scenario, you can't show this capital conservation buffer as a part of your capital. In that scenario, you can't pay dividends. In one hand, you can't say, I don't have capital. In the other hand, you can't pay dividends. That is profit out. Tier 1, you have P&L reserve. Okay? So capital conservation buffer is 0.625 to 2.5% of your risk-weighted asset. Supervisor, national regulator can decide the CCB, what is applicable to different countries. If you are using CCB to show your capital, in that year, you are not allowed to pay dividends. Right? That is CCB, capital conservation buffer. Then counter-cyclical buffer. Again, it is 0 to 2.5. And central bank can impose this at any time. If central bank thinks that there is a huge unwanted credit growth in the market, they can come and say, you allocate 2% or 1.5% of your capital to this buffer, counter-cyclical buffer. That is to reduce your capital and to balance the lending. For lending, you need capital. If you take out your capital to this counter-cyclical buffer, you don't have capital to lend. When you don't have capital to lend, your asset book will come down. Right? That is to control banks in creating asset book. That is to limit the credit growth in the country. This addresses excess credit growth that could result in building up risk. So they can come and say, you operate counter-cyclical buffer now, 2% of your risk weight you have to separate out. Then you don't have capital to show your capital adequacy. Right? These are the main two differentiators from Basel II to Basel III. Right? This is how the capital requirement grew year on year till 2019, tier 1, co-tier 1 and capital. But now we are at 12% to a capital adequacy. We wanted to go to 14.5%, but last year we restricted us to 12% capital adequacy. Right? So that is Basel II, III. Yeah. What is the impact of increased capital requirement of credit. When capital requirement increases, your credit comes down. Why? You don't have enough capital. Because we have limited capital, enough capital to grow your credit. If you want to grow your credit, grow your balance sheet of a bank, you need to support that balance sheet with the capital. Without capital, you can't lend. The best example is Basel 1, right? $800, you need to have $8 your own fund. 92 only you can borrow and lend. If your practices are good from Basel 2, your capital requirement will come down, right? So increased capital requirement means controlling the credit. Okay, I think we are done. Well, I have finished both. Any questions from Basel? Any questions? So Basel came in order to manage banks playing in international or same level, in order to have a level playing field for all the banks. If you are small, do small business. If you want to do bigger business, you need to graduate. Without proper capital backing, you can't come and do bigger businesses. That is the thinking behind Basel. Then Basel 1 came out with the capital adequacy ratio, which is Cook ratio or minimum MCR, capital adequacy requirement, which is capital divided by risk-weighted asset. Risk-weighted asset is direct asset or indirect asset. Indirect assets need to be converted to direct asset before calculating the capital. Indirect asset multiplied by credit conversion factor will create the direct part of the indirect asset. Basel 1 considered only risk is credit risk, and they gave 4 risk weights to be used. There, all the private lending was in one category. It is the 100% category. Therefore, different banks could play differently. So regulatory capital arbitrage occurred. Therefore, Basel 2 came in, because Basel 1 considered only credit risk. Subsequently, 1996, they introduced market risk as well, but they didn't bother about operational risk. So because of these reasons, Basel 2 came in 2004, right? Then Basel 2 was a 3-pillar model. Pillar 1, which looks at credit risk, market risk, and operation risk. Each risk type was calculated using 3 different methods each, right? There were several menus to use. Pillar 1. Pillar 2, it is to cover all the risks except previous 3 risks. We have ICAP, Internal Capital Adequacy Assessment Process, which will be used to calculate the risk relating to reputation, legal, liquidity, everything. And the supervisor needs to look at our processes and redo the calculation and authenticize the calculation. So that is called Pillar 2. Pillar 3 is market discipline. Market will look at your books, look at your disclosures, and decide whether we are going to invest in bank A or bank B. Based on that, indirectly, Market will control your capital availability. So when based on your capital availability only, you can play in the market. So third method is that. Then came the Basel III, which talks about the core capital of the core tier 1 of the core capital, tier 1 capital, that is share capital. On top of that, they introduce two methods, two ratios, capital conservation and countercyclical buffer. You need to allocate funds. Both the two of them were used. One for controlling the credit growth. Then the other one is for a bad situation. Whenever you are using on the CC countercyclical buffer CCB, you can't pay dividends, right? Capital conservation buffer, you can't pay dividends. Countercyclical buffer is used for controlling the credit growth. So that covers entire Basel lecture from me. If you have any questions, I can answer you. Oh, thank you very much for today. Next week we have two more lectures. We have to do credit admin and derivatives. Right? Okay. Thank you. If you don't have any questions.
Excuse me, sir.
Yes.
Sir, what is a non-cumulative perpetual shares?
Yeah. Preferential shares is like you have ordinary shares where when liquidation happens, you will be the last to pay. Like you go and buy shares from the share market. Those are ordinary shares. If a liquidation happens, everyone will pay. If something left, you will be paid. Right? But there are some other shareholders which are called preferential shares. There we say give a confirmed rate of return for those kinds. Like we don't know what is the dividend will be paid for ordinary shareholders until unless company declares. But under preference shares, what happens? They say, okay, give me share money, I will pay you 10%. Annually 10% dividend. That is a given rate. Even they pay 50% for ordinary shareholders, preference shareholders will be paid 10% because it is guaranteed dividend payment. And again, normally preference shares are cumulative. That means if they don't pay this year, they have to pay it next year. Right? This year part also, they have to pay next year. They can postpone, but they can't avoid paying. They need to pay. There it was non-cumulative. That means that accumulation plus will not happen, but if you have profits, definitely you will be paid. That is preference shares, non-cumulative. Normal preference shares means if you don't pay this year, that amount need to pay next year. Clear? Is it okay?
Yes, sir.
Right. Any other thing? Anyone else? Okay. If no questions, thank you. We'll meet next week.